While we've got a very special guest on the show, Rana Gupta, Manulife. Let's connect with him to understand the global mood point for India, what is happening to flows, and how exactly this domestic liquidity-driven market will continue in terms of valuations and in terms of momentum. Ramana, fantastic to have you back. Thank you for joining us. What would you
Good morning.
attribute the strength to India? Is it local flows or is it global in nature?
Oh, it's the local flows. Definitely. I mean, for this calendar year, on an annualized basis, local flow running like $100 billion this year. And I think global flows, even if you were to think that will pick up for the rest of the year, don't think it's going to cross 15, $20 billion. So it's the local flows that is definitely taken the lead this year for this calendar year.
Which is driven less by earnings and more by flows. What is the best way to participate in this market, or what is the best way to really maximize in this kind of a market?
I think firstly, the earnings have been quite resilient, I would say. I think the earnings since 2021-22 has picked up and continued at the mid-teen CAGR, and that is expected to continue. There is a healthy earning growth, but of course the market has gone up more than that. So to that extent, there's been a PD rating. The PD rating has been more into the mid-cap kind of stocks. So here I think the liquidity plays a role, because if you're talking about $100 billion of flows coming into the market, uh, much of domestic flows into mid cap and small cap. In terms of market cap wise, mid cap, small cap is probably about 25 to 30% of the market. Now, this 20 to 30% segment getting 70, 80% of flows, the prices are moving up, and that's the PE ratios are moving up. Now, having said that, I think this domestic liquidity continues to remain strong. I think the market will trade at a somewhat premium valuation, and there are reasons for it. I think if you look at take a step back and look from a macro standpoint, you would see that the fiscal deficit has come down remarkably. Current account is well within control. The company's profitability, the PAT growth ratio, ROEs have improved. And even for foreign investor, when you compare with other emerging markets, there is hardly this kind of, the fiscal consolidation, current account getting better, corporate profitability so strong kind of theme. So I think sooner or later, as probably the global liquidity situation improves, FI flows should also be back. But I still think the local flows continue to will continue to play a major role in Indian markets.
And when do you think our fair weather friends, FIs, they will come back? Because you do have a situation where FIs have been selling, and they've been selling on a consistent basis.
So I think if you decipher the FI selling, it was largely concentrated in financials, and that to one of the large banks, and that had a merger and so many things on their own. Our sense is that the situation on the liquidity in India, liquidity is in the liquidity, surplus liquidity or lack of it, and the rate scenario in India will also eventually turn with the global interest rates turning, and that should brighten up the outlook for the one or two larger banks which particularly suffered due to lack of liquidity. That's the first thing. Secondly, in the financial space, which has been FI's favorite for a long time, I think with the specter of rates coming down, the non-banking space or the medium-sized banking space, where the lenders have a fixed asset kind of a book, that will start to look very exciting. So I think overall, we are expecting that finance sector, which had seen the brunt of the selling, should do well going forward, and that's how we think the FI's flows comes back. Hopefully, during the rest as the Fed cuts rate towards the later part of this year.
Morning, Rana. I wanted to get in your take, given that as part of the sectoral positioning, domestic demand plays are looking at like a promising sector. What do you believe this would largely be led by? And if I could also weave in a question as to what your outlook is when it comes to the rural economy recovery.
Sure. So far, I think if you go back last 2 to 3 years, the markets have been driven by largely the industrials and the PSU and the real estate and those kind of stocks. And there was, for a good reason, because the government spending on capex was extremely strong. I think probably very 20% plus, if I remember them correctly. Whereas government spending on revenue expenditure were quite subdued. In fact, the consumption part of the economy grew only 3 to 4% CAGR in the last 3 or 4 years. Now we believe, even if you look at the GDP data, We believe that is turning slowly but surely. There is some uptick in consumption, including rural consumption. It will be a well-paced gradual recovery. Industrials part of the economy, I think, will continue to hold up, but incrementally, the stocks, given the valuation they're trading at, they might run out of triggers. In this kind of a scenario, we like the place where there is chance of cash flow inflecting. We think telecom is one sector where the cash flow are inflecting. We think in the consumption, particularly the real estate linked consumption plays, whether it is pipes, cables, wires, white goods, that's also another promising sector. And as we already discussed, one of the other ways to play the consumption coming back is to play the non-banks, which are also very exposed to the rural sectors, and also the larger banks, which have suffered due to the liquidity tightness in the recent past.
Just continuation to that, you've always emphasized on the 5D framework, right? I mean, digitization, deglobalization, decarbonization, demography, deficit reduction. When looking at the investment thesis, help us understand as of now and given the visibility 2 years hence, which sectors do you think fit these 5 criteria?
Sure. I think digitization is something which you continue to be positive on, because after all, you're catering to a large market, and data is nothing but consolidating, right? It's a platform-based companies. Now there are companies in that segment who are adding services on the top of the platform. So basically, they are expanding and not at a very big incremental cost. So we continue to like that theme. In the deglobalization, which is basically about manufacturing, we continue to like the themes which are more like China plus one. And whereas the companies who are dependent on government capex, there we are turning a bit cautious from a stock price perspective. Decarbonization is basically the renewable energy plays. There we think, the renewable energy, the wind energy companies or the solar panel companies, they are trading at very high valuations right now. So best way to play it will be through the transmission, through wires, cables, and some transformer kind of companies. And then we come to the themes of demography, where we discuss that the consumption is slowly coming back, and we discuss the themes to play that. Last but not the least is deficit reduction. Now, deficit reduction you can play through banks, one can play through non-banks, where the cost of funds will go down. But there's one more point I would like to make, and this is linked to the domestic liquidity, where this discussion also started. Deficit reduction is also very good for wealth and asset managers. They continue to see flow, and if you think about it, they really don't have to invest a lot of fixed cost to get this kind of flows. Therefore, the cash flows in that segment also going to be very strong. So that is another sector that we like.
Rana, in the light of where IT and global AI is moving, where does Indian IT company fit in? I mean, IT index is at an all-time high, even though the general view is that these businesses will get disrupted. So given that the market is confused about impact of AI on Indian IT services, why has the IT index hit an all-time high?
Sure. So I think that was the view probably 6-9 months back, that AI will significantly disrupt Indian IT businesses. They will find it difficult to grow the revenues. But the way it has panned out in last 16 months, what we have seen is that the Indian IT companies, they have kind of disrupted themselves by embedding AI into the solution to the clients. This has meant pretty, low revenue growth in the near term, but very accelerated deal wins. Now, when these companies come and talk to the investors, they highlight that as the deal wins have grown at the cost of, let's say, near-term revenues being slow, the revenues will gradually ramp up, and as they can productize these AI solutions, their margins will also go up, and they have enough levers to control that margin. That has been the narrative. So I think right now there is some comfort coming in among the investors that the Gen AI may kind of deflate the revenue in the short term, but medium term is not such a bad thing. But that's more of a structural outlook. Cyclically, I think all the IT companies have been highlighting that in the corporate boardrooms of US, some kind of comfort has now revived, given the Fed put, the global Fed put is now back. So they are not as cautious. So therefore, I think the sentiment towards IT sector have kind of come better. Anyway, these stocks, in relation to the market, they are not very expensive. I think many of the large cap IT stocks trade at around 3% yield or thereabouts. So they are not very expensive. And given the positioning was light, and given what just happened on the JAI structural theme and the cyclical theme on Fed cutting outlook, and therefore US boardroom confidence being back, we think that this sector has seen some of move.
Rana, where in this current market would you say avoid venturing into it or putting fresh money to work, or at least sensing some signs of fatigue, you think?
I think that way we have to look at industrial sector, because this sector has rightly so had a huge run up. I think industrial sector, the government investment themes will continue, but given the valuation they're trading at 30, 40, 50 times, you need very accelerated growth, that's 25, 30%, which has happened in the last 3 years. But we doubt that kind of growth rate can sustain for a very long period of time. The kind of valuation these stocks are trading at, they demand constant catalyst, constant growth surprises. We suspect that may not be the case going forward. So that is one segment we would be cautious about.
Rana, so what should be in your mind when you look at managing funds in India, dollar return expectations for next 3 years in terms of CAGR?
So we think, even if I were not to factor in any re-rating of the market, we think that the EPS growth can be quite strong, could be in mid-teens, take it 14, 15%. And we do have a pretty, constructive outlook on the rupee as well. But even for you begin to be conservative, a 1-2% downside. Then also looking at for probably early mid-teen US dollar kind of currency returns. And these returns are perfectly consistent with the past trends. If you look at last 4, 5, 7 years longer term time frame, Indian markets have returned that kind of US dollar returns. And we see no reason that cannot continue.
So let's say this market is trading above historical averages. But when you look at things like liquidity, domestic flows, problems in the world, but India growing on a relative basis, absolute basis, could these factors keep the PE multiple high? And can India deserve to trade at this pedestal positioning? I remember reading financial history, and there was a time when China traded really at high PE multiples because they had growth. US tech stocks have traded at PE multiples which are absurd if one look at historical benchmarks, but they are growing. Can the same happen with India, that rather than looking at beast time, 21 times, 23 times, this is manga, that is manga, just be with the market?
See, at an aggregate level, Indian markets are a tad expensive, but not very expensive. The expensiveness has come more in the sectoral level. So I think if someone expecting that, a 50, 60 PE for, let's see, transformer commerce company sustaining, I think that is where one would face some challenges. But at the market level, I think, the Indian market PE overall for last many years have been 15, 16 times. It has gone up to 17, 18 times. So it's trading at tad expensive. But again, taking a step back, as you yourself remember to the points that better macro, global liquidity, domestic liquidity, good earnings, all that is helping. So from our thinking like picking look at company of the country, I think for all the factors that we discussed, this market has seen a re-rating, and at an aggregate market level, the valuations are only a tad higher, justified by all the macro improvements. At sector level, there are dispersions. I mean, just look at last 1 year returns. I think some of the industrials and the PSU stocks are probably about 100%, whereas the sector that we are constructive and that we discussed, some of the select consumer or some of the select or the banking or the non-banks, they are probably 15-20%. So we see a lot of opportunity remaining in those segments due to the way the macros are showing up and the macros are aligning.
Rana, so good chatting with you today and getting in all that perspective. Thanks for your time.
Thank you.
Okay, let's just